Welcome back to the deep dive. It is January 18th, 2026. And I have to be honest with you, I spent the morning reading through the headlines, and I feel like I'm looking at two completely different worlds.
It definitely feels a bit schizophrenic out there right now.
Schizophrenic is the right word. On one screen, I'm seeing reports of office buildings in major cities selling for, and I'm not exaggerating here, pennies on the dollar compared to what they were worth 4 years ago.
It's absolute carnage.
Total carnage. And then on the next screen, I'm reading about bidding wars. Actual bidding wars for dirt patches in the middle of nowhere. It feels chaotic.
It does.
So the mission for today is simple, even if the topic isn't. We are going to try to cut through that noise.
And we're going to do that by ignoring the headlines and looking at the raw data. Because if you look at the stack of research we have for this deep dive, everything from CBRE's 2026 outlook to some really dense forensic accounting reports on distressed assets, you realize the chaos isn't random.
Oh, interesting.
It's actually very structured.
Structured chaos. I like that. But usually when the economy is doing okay, real estate does okay. A rising tide lifts all boats, right?
That phrase needs to be retired. Seriously. In 2026, the era of a rising tide lifts all boats is completely dead.
Wow. Okay.
We are living through what economists are calling the Great Bifurcation, or if you want to visualize it, a K-shaped recovery.
The letter K. So a vertical line and then two arms branching out. One goes up, one goes down.
Exactly. And the gap between those two arms is widening every single day.
Okay.
On that upward arm, you have assets that are absolutely skyrocketing, things like data centers and, surprisingly, industrial logistics. On the downward arm, you have what the industry is calling zombie assets.
Zombie assets. I want to put a pin in that because zombie asset is arguably the coolest and most terrifying term in finance.
It really is.
We are going to dig deep into how to spot a zombie before it eats your portfolio later on. But we're also going to talk about some things that frankly surprised me. We're going to discuss why a gravel parking lot might be more valuable than a glass office tower.
It often is.
Why the shopping mall, yes, the place you went as a teenager, might be the safest investment in America right now, and why the map of hot markets has completely flipped.
It really has. Yeah. The cities everyone loved in 2021 are not the winners in 2026. But the biggest takeaway, the thing you need to understand before we get into the specifics, is that the easy money is gone.
Define easy money.
I mean, the strategy of buy a building, wait 3 years, and sell it for a profit because interest rates stayed low, that game is over.
So no more passive income.
You cannot passive income your way to wealth in this market.
Okay, that feels like the perfect jumping off point. If the easy game is over, what's the new game? I want to understand how we got here, because to understand 2026, I feel like we need to look back at the last decade.
We do. And if we look at the commercial real estate history and analysis source we pulled, it frames this perfectly as the battle between two Greek letters, alpha and beta.
Okay, I didn't know we were doing a fraternity rush, but walk me through it. Beta usually refers to the market, right? Like, if the S&P 500 goes up 10% and your stock goes up 10%, that's beta.
Right. It's market-driven growth. For the better part of the 2010s and the early 2020s, real estate was a beta game. The economy was growing, sure, but the real driver was interest rates.
When you were near zero.
Free money, basically. And when you have free money, you get what's called cap rate compression.
Okay, that's a bit of jargon. Break that down.
It's a fancy way of saying that because borrowing was so cheap, investors were willing to pay more for the same amount of income.
I see.
Asset values inflated naturally. You didn't have to be a genius landlord. You didn't even have to be a good landlord. You just had to hold the deed and wait.
So I could have bought a mediocre building, ignored the tenants, never fixed the AC, and because the market was so hot, I still would have sold it for a profit 5 years later.
You would have looked like a genius on paper. But that creates a false sense of security. It makes people think they're brilliant investors when really they were just surfing a wave.
And the wave is gone.
The wave is gone. The tide is out. And we are seeing who is swimming naked.
And that brings us to alpha.
Alpha is the return generated by skill. It's idiosyncratic. It's not about what the market is doing. It's about what you are doing to the building to make it better.
Okay.
And here is where it gets really counterintuitive. We pulled an academic paper. It's labeled WP173 in our notes that actually quantified this. They looked at which sectors allow for the most alpha.
I would assume the good sectors, right? The stable ones. Apartments, maybe?
You would think so. But the data shows the opposite. Historically, office properties showed an alpha of 0.054.
0.054.
Compare that to apartments, which sat at 0.027.
Wait, hold on. You're saying office, the sector that is currently on fire in the bad way, has double the potential for skill-based returns compared to apartments. That doesn't make sense.
It makes perfect sense if you think about inefficiency. In a stable market like apartments, everyone knows what the rent should be. Everyone knows what a toilet costs to fix. The market is efficient. It's hard to be smarter than the guy next to you.
Because the playbook is written.
Exactly. But in office, especially now, it's chaos. Nobody knows what a building is worth. Nobody knows if tenants will renew. That massive inefficiency is where the alpha hides.
So there's opportunity in the
A
chaos.
smart operator, someone who really knows how to restructure a lease or amenitize a lobby, can squeeze out value that the market completely misses.
So because it's a mess, there's opportunity, but it sounds like hard work.
It is incredibly hard work. The days of the lazy landlords are extinct. The sources are emphatic about this. We have moved from rent collection to operational excellence.
Operational excellence sounds like corporate speak. What does that actually look like on the ground?
It means using data to fight for every margin point. I mean, the winners in 2026 are using IoT Internet of Things sensors to monitor energy usage in real time, shutting down HVAC on empty floors instantly.
So they're not just waiting for the utility bill at the end of the month.
Not at all. They are curating tenant experiences like a hotel concierge. If you aren't doing that, you are losing to the guy who is.
Okay, so if we have to actually work for our money now, let's talk about where we should be working. Let's talk about the golden child. For the last 10 years, if you said industrial real estate, people threw money at you. Is that still true? Or has the golden child lost its shine?
The golden child has grown up. It's still the darling of the industry, but the narrative has shifted.
How so?
For a decade, the story was just Amazon, e-commerce, people buying toothpaste online.
Right, we need more boxes for the toothpaste.
And that's still happening, but it's not the main driver anymore. According to the deep dives from Prologis and CBRE, the new drivers are supply chain resilience and power.
Resilience. That sounds like a reaction to the pandemic.
It is. The just-in-time model, where you keep zero inventory and pray the ship arrives on Tuesday, broke. It failed.
It spectacularly failed.
Now, companies are moving to just-in-case. They're hoarding inventory. But the real insight, the aha moment from the Prologis report, is the math behind why they're willing to pay so much rent.
Okay, break down the math for me.
So Prologis analyzed the total supply chain cost for their average tenant. If you take every dollar a company spends to get a product to a customer, labor, transportation, manufacturing, rent, guess what percentage of that pie is actual rent?
I don't know. Rent is expensive. Maybe 20%.
25%.
5%. That's it. No way.
5%. The vast majority of the cost is transportation trucks, fuel, drivers, and labor.
Wow.
So Prologis realized they have massive pricing power. They can go to a tenant and say, hey, I have this warehouse. The rent is 20% higher than the one across town, but it's located right next to the highway on-ramp and the population center.
Which cuts down the driving time and the fuel costs.
Right. If that location saves the tenant 10% on transportation costs, which is a huge slice of the pie, they can afford to pay 20% or even 30% more in rent and still come out ahead on total cost.
That is fascinating. So the rent is almost a rounding error compared to the gas bill.
Exactly. That is the location efficiency premium. And that plays into the other big trend, nearshoring.
Right.
85% of companies now want to make and sell their products in the same region. They are done with shipping things across the ocean if they can avoid it.
Which brings me to a term I saw in the notes that I honestly laughed at when I first read it. Industrial outdoor storage. IOS.
Oh, yes.
It sounds very technical, but I looked up some listings and it's a parking lot. It's a gravel lot with a fence.
It doesn't look like much, does it?
It looks like a place to dump a body in a movie. Are we really telling people that the sophisticated high finance play of 2026 is buying a dirt patch?
I know, it sounds ridiculous.
Yeah.
But in the industry, iOS is being called the hidden gem of the decade. And the reason is simple. Economics.
Okay, convince me.
Think about the office tower we just discussed.
Elevators, glass, marble lobbies, window washers, high maintenance.
Endless maintenance. High capital expenditures. Now look at the iOS site. What is your maintenance? Grading the gravel once a year, fixing a hole in the chain link fence.
So your operating expenses are basically zero.
Close to it, which means your expense recovery is incredible. The sources indicate that iOS trades at cap rates 50 to 100 basis points tighter than traditional industrial.
Wait, tighter so a lower return?
It means investors are willing to accept a slightly lower yield percentage because the income is so safe and the headaches are so small. It's a premium for simplicity.
It's the low-maintenance relationship of the real estate world.
It really is. It's pure utility. Parking for trucks, storage for shipping containers, lay-down yards for construction equipment. You can't put that stuff in a warehouse. It's too expensive. You need dirt.
And in cities, dirt is disappearing.
It's the one thing they're not making more of.
So where is this dirt? You mentioned earlier that the map is changing. I assume we aren't talking about storing trucks in downtown Manhattan.
No. And this is the MSA surprise we teased in the intro. If you're looking for the next boom towns for this kind of logistics real estate, you aren't looking at LA or New York. You're looking at Louisville, Columbus, Greenville, and Kansas City.
Kansas City. Okay. Why there? Is it just because they have space?
It's central, but it's also about the type of space. We are seeing a shortage of what's called first-generation facilities.
Meaning?
Big, modern blocks of space, 500,000 square feet plus. In the coastal hubs, you can't find the land to build that anymore. It's gone. But in Columbus or Louisville, you can. And these cities are within a one-day truck drive of half the U.S. population.
So if you are a 3PL, a third-party logistics provider, you want to be there.
Exactly. And 3PLs are the whales right now. They're taking 35% of all leasing activity. Companies are outsourcing their headaches to 3PLs, and 3PLs are moving to the Midwest.
Follow the trucks, find the money. Okay, let's pivot. We cannot do a show in 2026 without talking about the two letters that changed everything, AI.
It's the monster in the room.
But I want to get specific. How does AI change real estate? Robots don't rent apartments. Not yet, anyway.
No, but the brain of the AI needs a home. And that home is a data center.
The cloud is actually on the ground.
Right. And the demand shock we are seeing here is unlike anything in history.
Right.
The vacancy rate for data centers in primary hubs, Northern Virginia, Silicon Valley, is effectively zero.
Yeah.
You cannot find space.
So basic economics, demand is high, supply is low. Why don't they just build more?
They are trying, but they are hitting a wall, a literal power wall. And this is the most critical constraint in the entire commercial market right now.
Is it materials? Labor? What's the holdup?
It's juice, electricity. Here is the nightmare scenario keeping developers up at night. You raise the capital, you buy the land, you pour the concrete. You build $1 billion state-of-the-art facility. It takes about 12 to 18 months. Yep. You're ready to open.
That sounds good so far.
You call the utility company to turn it on, and they say, great, we can get you the interconnection you need in 2030.
4 years. You have $1 billion building sitting dark for 4 years.
That is happening right now. The interconnection queue for power transmission in some markets is 48 months or longer. You have the building, but you don't have the power.
That is wild. So how are investors solving this? You can't just wait 4 years.
They're solving it by splitting the asset class in two. We call it bifurcation. You have training centers and inference centers.
Unpack that for us. What's the difference?
Training is when you are teaching the AI. You are feeding it the entire internet so it learns to speak. That requires massive, massive power. We're talking 100 megawatts, 200 megawatts.
A huge amount of energy.
But here's the key. It doesn't matter where it happens. The computer doesn't care if it's in a cornfield or a city because nobody is waiting for an instant answer. It's not latency sensitive.
So you send the training to wherever the power is cheap and available.
Exactly. Rural areas. Central Washington State is big for this because of hydropower.
Yeah.
But inference is different. Inference is when you use the AI. When you ask a chatbot a question and expect an answer in milliseconds, that needs low latency. Those centers have to be edge locations, close to the users in the cities.
So we have rural power guzzlers and urban speed demons.
Yes. And for the listener looking for the hidden gem, the play is finding markets where you can bypass the utility company.
Bypass the utility. Is that legal?
In deregulated markets, yes. We call it bring your own power, or BYOP. You can build your own substation. You can strike a deal directly with a power plant.
Wow.
And the sources point to 3 states specifically where this is opening up massive opportunities: Alabama, Mississippi, and Louisiana.
The Deep South. Not exactly what comes to mind when I think high tech.
It shouldn't. But physics doesn't care about reputation. These states have robust power infrastructure, natural gas resources, and a regulatory environment that says, yes, please, come build here.
So Mississippi is becoming the new Silicon Valley, not because of the silicon, but because of the voltage.
It's the only place you can plug in. And AI users, companies like NeoCloud or GPU service providers, are paying massive premiums. They used to get bulk discounts for using so much power. Now, they pay whatever the landlord asks, as long as the lights turn on.
That is a total paradigm shift. Okay, let's talk about another sector that has had a paradigm shift, but in the opposite direction, retail.
The retail
So
apocalypse.
exactly. For 10 years, the narrative was malls are dead. Department stores are dead. Everyone is shopping on their phone. Put a fork in it.
Yep, that was the story.
But looking at the data for 2026, retail seems to be the safest bet on the board. How is that possible?
It's possible because of the apocalypse narrative.
Explain that.
Think about it. Because everyone was convinced malls were dying, nobody built any new malls. For a decade, construction of new retail space fell off a cliff.
Right.
So now we have a growing population, consumers who still want to leave their houses, and a supply of retail space that is effectively capped. Extreme scarcity. The survivors, the Class A malls, the high-end shopping centers are winning by default. Simon Property Group, one of the biggest mall owners, is reporting occupancy rates over 96%.
96%. That is incredibly healthy.
It's fantastic.
But the malls themselves,
Right.
they don't look like the malls I grew up in. The Sears is gone. The JCPenney is gone.
And thank goodness for that. The anchor tenant has changed.
Yeah.
This is the rise of what we call medtail.
Medtail, medical retail.
Walk into a mall today. That empty department store box. It's not another clothing store. It's a dialysis clinic. It's an urgent care. It's a high-end cosmetic dentistry office.
That's actually brilliant. You go for a checkup, and while you wait or after you're done, you're already in the ecosystem to grab lunch or buy shoes.
It drives consistent foot traffic. People have to go to the doctor. They don't have to buy a sweater. It stabilizes the asset.
Interesting.
And the other piece is entertainment. We are seeing malls pivot hard to experiences. High-end bowling, arcades, pickleball courts.
Pickleball really is taking over the world.
It is, but the data supports it. The sources show that malls that integrate these leisure components see dwell time increase by 25% to 35%.
Dwell time.
The amount of time a customer stays on site, the longer they stay, the more their wallet opens. So, contrary to the headlines, retail in 2026 is a stability anchor. It's scarce, it's evolved, and the cash flow is solid.
So don't bet against the American consumer's desire to get out of the house.
Never bet against the consumer.
All right, we've talked about the winners. Industrial, AI, retail. Now I want to go to the dark side. I want to talk about the losers. Section 5, the distress. You mentioned zombie assets earlier.
The zombies. This is primarily the office sector, but I need to be clear. Not all office is bad.
Right.
If you own a trophy building in Miami or a boutique office in Nashville, you're probably fine. The edge for an investor is knowing how to spot the buildings that are already dead but haven't fallen over yet.
So paint a picture for me. What does a zombie asset look like? If I walk into the lobby, do I know?
That's the scary part. You might not. You might walk into the lobby and there's a security guard, the lights are on, there's music playing, but the building is suffering from shadow vacancy.
That sounds like a horror movie title.
It's a financial horror movie. Shadow vacancy is when a tenant is still paying rent, so they show up on the rent roll, and the bank thinks the building is 90% occupied, but the tenant isn't actually there.
They're physically gone. Their space is empty.
Their employees are working from home. Or the company moved its HQ to a cheaper state and just decided to pay out the rest of the lease rather than fight a legal battle.
So the building feels empty.
The coffee shop in the lobby goes out of business because there are no customers.
And the bomb is ticking.
The bomb is the lease expiration. When that lease burns off in 2027 or 2028, the tenant doesn't just downsize, they vanish. The income drops to zero overnight. The building value collapses.
So how does a smart investor spot this before it happens?
You have to look for the brown discount.
Brown discount. I assume this is the opposite of a green premium.
Correct. This is about regulatory obsolescence. We're seeing strict laws, like Local Law 97 in NYC, that impose massive fines on buildings that aren't energy efficient.
Okay.
If you own a glass tower built in 1980.
Which is basically a greenhouse that traps heat.
Exactly. It's an energy nightmare. If that building isn't Energy Star certified, it is facing millions in fines and millions more in Capex capital expenditures to fix the windows and HVAC.
An impossible situation for the owner.
Investors are filtering specifically for these assets, built before 1990, not Energy Star certified. These are the zombies.
They're brown, not green, and they are broke.
And here's the trigger event. You don't just look for a bad building, you look for the maturity wall.
This is the timing component.
Think back to 2021. Interest rates are rock bottom. Prices were at their absolute peak. Investors bought buildings using short-term, floating rate debt, usually 3-year or 5-year terms.
And 2021 plus 5 years is 2026.
Those loans are coming due now, and the math is catastrophic. The building is worth 30% less than they paid for it. The interest rate to refinance is double what it was. The bank won't extend the loan because the asset is underwater. They are mathematically doomed.
So the owner has to hand back the keys.
Or bring a massive check to the table, which they likely don't have. This is where the opportunity is. But notice who is stepping in. It's not the big banks.
The banks are scared.
The banks are handcuffed. Regulations like Basel III have forced traditional banks to retreat from commercial real estate exposure. They don't want these loans. So private credit is stepping in.
Private credit, these are the non-bank lenders.
Hedge funds, private equity debt funds. And they are buying the paper. They aren't buying the building. They're buying the mortgage from the bank at a discount.
Why buy the mortgage instead of the building?
It's safer. You get to be the senior lender. You might get an 8% to 10% return just from the interest. And if the owner defaults,
You foreclose.
you foreclose and take the building for a steal. It's a way to get equity-like returns with debt-like safety.
That is a fascinating shift in the plumbing of the financial system, the privatization of the capital stack.
It's huge. It's a fundamental change.
Okay, we've covered a lot of ground conceptually. I want to talk about actual ground, geography. We mentioned the Midwest earlier. But for the last 5 years, the only thing anyone talked about was the Sun Belt. Austin, Phoenix, Nashville, Tampa, everyone moved there. Is that trade over?
The people trade isn't over. People still like warm weather and low taxes. But the real estate trade is in trouble. We have a twin dilemma in the Sun Belt.
Which is?
Too much popularity leads to too many cranes. Developers saw the migration and they went crazy. We're seeing a 50-year high in new apartment deliveries in places like Austin and Phoenix.
A 50-year high. That is a wall of supply.
It's a tsunami. So even though people are moving there are more apartments than people. Rents are flat. In some submarkets, rents are actually dropping.
Wow.
Concessions are everywhere. 2 months free rent. Signs are popping up like mushrooms.
So if I'm an investor looking for growth today, not in 5 years, I should avoid the hotspots.
You should look where the developers didn't go. The Midwest and the Northeast.
The unsexy markets.
The stable markets, Indianapolis, Columbus, Minneapolis.
Minneapolis. I feel like I never hear Minneapolis mentioned in the same breath as high growth.
It's not explosive growth, but it's profitable growth. High barriers to entry. It's hard to build there. Regulations are tighter. Winter is tough. So developers didn't overbuild.
Ah, okay.
Now vacancy is low and rents are growing a healthy 3% to 5%.
It's the tortoise and the hare. The Sun Belt sprinted and passed out. The Midwest just kept walking.
And remember the manufacturing piece. The Rust Belt is becoming the manufacturing belt again. The CHIPS Act, the reshoring of battery plants, that is all happening in Ohio, Indiana, Michigan.
Right.
That creates jobs, which creates demand for housing in markets that aren't drowning in supply.
It all connects. The industrial boom drives the housing stability in the Midwest.
Exactly.
Okay, we have the landscape. We have the winners and losers. Now I want the playbook.
Yeah.
If I'm a listener, let's say I'm a high net worth individual or a small fund manager, and I want to find one of these deals. I want to find a distressed asset before it hits the auction block. How do I do it? Section 7 calls this the distress funnel.
Right. This is the tactical how-to derived from the distressed CRE outlook. It's a 4-step process.
Step 1.
The macro screen. You can't just drive around looking for sale signs. You need data. You use tools like TREP or CoStar to filter for loans. Specifically, you want loans that were originated between Q4 2020 and Q2 2022.
The peak pricing window.
And you filter for floating rate. You are hunting for the victims of the rate hike.
Okay, so now I have a list of suspects. Step 2.
Verification. You need to confirm they are actually in trouble. You look for public records, list pendens.
Which is Latin for lawsuit pending, basically.
It's a pre-foreclosure notice.
Yeah.
Or you look for tax liens. If a landlord isn't paying their property taxes, they're definitely out of cash. This confirms the distress is real.
Okay. Step 3.
The operational check. This is where you look for the Brown discount we talked about. Look up the building's Energy Star score. Is it efficient? Or is it a dinosaur? If it's a dinosaur, you know the owner is facing a massive Capex bill they can't afford. That gives you leverage.
And finally, step 4. The kill shot.
This is the most important part. Do not call the broker.
Why not?
If a broker has the listing, it's already being marketed to 1,000 people. The price will get bid up. You want an off-market deal.
So you have to get there first.
You use data tools like CRED, IQ, or Reonomy to pierce the LLC.
Find the human behind the curtain.
123 Main Street LLC is owned by John Smith. Find John Smith's cell phone number.
And you just call him.
You call him directly. You say, John, I know your loan is maturing in October. I know you have a tax lien. I know the building needs $2 million in energy upgrades. Let's make a deal today before the bank takes it and ruins your credit.
That is incredibly aggressive.
That is what operational alpha looks like in 2026. You don't wait for the market to give you returns. You go out and extract them.
It's a sniper's market, not a shotgun market.
That is a perfect way to put it.
Wow. Okay. We have covered a massive amount of ground today. I want to try to summarize the big aha moments for you.
Let's do it.
Number one, the industrial sector has evolved. It's not just about boxes for Amazon. It's about power and cost savings for supply chains. And the hidden gem is the humble dirt patch industrial outdoor storage.
Low OpEx, high necessity. Can't go wrong.
Number two, data centers are the hottest asset on Earth, but the constraint is power transmission. The smart money is moving to deregulated markets in the deep South Mississippi, Alabama to bypass the utility bottleneck.
Chase the gigawatts, not the fiber.
Number three, retail is safe. Why? Because we stopped building it 10 years ago. Scarcity has created a floor for value, and Medtail is filling the vacancies.
Supply and demand at work. It's that simple.
And number four, distress is real, but it's hidden in the shadow vacancy of office buildings. The play is finding the zombies, 2021 floating rate loans on inefficient buildings and intercepting them before they hit the market.
That is a formula.
So, as we sign off, what is the one thought you want to leave with everyone listening today?
I'd say this. The era of being a passive investor is over. The rising tide is gone. We are in a stock picker's market for buildings. The winners in 2026 won't be the institutions with the most capital. They will be the operators with the best data and the willingness to do the dirty work.
Data is the new capital, and looking at a spreadsheet is now more important than looking at the skyline.
Absolutely. And I'd challenge you, the listener. Don't just take our word for it. Drive around your own city. Look for that K-shape. Which shopping center is full of dialysis clinics and luxury gyms? Which office building has the lights off at 8 p.m.? The data is right in front of you if you take the time to look.
The great bifurcation is happening on your street corner. Thanks for diving in with us. We'll see you on the next one.